For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Managing Your Financial Future. Thanks so much. This is the podcast. Oh, we got a good one today. Well, we always have a good one. I'm John Dean, your podcast host. Professor Rick Plum, certified financial planner professional and accredited wealth manager advisor. Now, we talked a few episodes ago about that lottery jackpot. Remember? It was like $1 billion, 60 billion, or 80, whatever. No, well, it was 1.8 billion. Well, somebody won it in early September.
2 people.
Which is old news. You know, by the time this podcast gets out, I think 2 tickets actually.
Yep.
2 tickets purchased one in Texas, one in Missouri. Both matched all 5 numbers plus the Powerball, and they're going to split the jackpot. 1.8 billion. So if you took a lump sum, it stood at
410 million each or so, give or take.
Yeah, I want to give you a stat on this very quickly, Professor Plum, and there's a point to all of this. The stat is that Americans. This may shock you or it may not. Americans spend more on lottery tickets than they do on movies, video games, books, music, and sporting events combined.
It doesn't surprise me, but that is a very large number.
It is. Even more astounding than that, the majority of lottery tickets in the U.S. are purchased by some of the poorest Americans. The lowest decile, according to this stat, of American households based on income spend an average of $412 a year on lottery tickets. $412 a year. And that's like 4 times the amount spent by the highest 10% of income earners in the U.S. But to think that the poorest people are spending money on lottery tickets, to most people that's going to seem crazy. And you know what? I mean, it is, but a few years ago, I would have said the same thing. But I heard a podcast recently where a host was interviewing someone who grew up, very poor, like as in no food in the refrigerator poor, that kind of poor. I think his mom had like $4 to her name at any given time. And this guy was saying, he said, hey, you know what? $4 was not going to fill up the refrigerator by any means, but it would buy 4 lottery tickets that had the potential to fill up the refrigerator. Now, I heard that and I thought, well, it still sounds nuts, but maybe I can see their justification for it. You know, in other words, the lottery ticket may be the one bit of optimism that they have, that they could, bring them instantly out of their predicament. So now those people who seemed really reckless, and it does seem reckless with that money, kind of seemed in a way rational. I mean, I could at least see through their eyes why they've rationalized it. So now, okay, so why am I mentioning this? What does it have to do with anything we normally talk about? Well, it's relevant because it's about breaking the normal rules of finance, okay? The rational advice for someone with no money, Rick, is to save whatever they can, anything at all, and build for their future. And that is sound, solid, excellent advice, I would say, for everyone. But I think it also demonstrates that the shorter-term circumstances or individual circumstances may allow someone to break those rules, even if it seems counterintuitive or possibly crazy to do so. Now, let me say this right off, okay? I am not suggesting anyone who's living paycheck to paycheck should play the lottery.
I remember, same idea. I remember an interview with somebody who had been one of the early winners of the $1 Million, which was like $50,000 a year payout for 20 years. And he was in this is like early 2000. He's in his 18th or 19th year of the payout, and he had nothing to his name. He hadn't worked for the last 20 years. His Social Security was going to be nothing. He had nothing. So what was his game plan? His idea was, I can take this $50,000 and invest it, and I'll probably be broke in 3 years anyway. Or I can buy 50,000 lottery tickets and be broke anyway. But at least then so you're saying there's a chance.
Well, and that's the thing. You see, if you look at it through their eyes and their circumstances, you might say, I wouldn't do that, I don't think. But there's a rationalization to it. I do believe. Now, everybody should save what they can. Don't gamble your future away on a 50 gazillion.
Well, he shouldn't have waited until the last minute to think about his future. Correct. I mean, he should have been saving some of that $50,000 every year.
Well, that's the idea. And obviously that's something that as a financial planner you would say. But I wanted to use this extreme example here, Rick, to show how certain financial rules can be broken when an individual's circumstances seem to dictate it. And I think it shows how even the most, steadfast, time-honored, seemingly perfect rule can have a flip side to it. So I want to today go over a few of the most common financial rules, I'll put that in quotes, to talk about and why it's a good idea to break them. Now, look, you've been a CFP for 30 whatever years. So I know you could come up with these. You could probably come up with about how long?
34.
34. Okay, whatever it was. But so I know you could come up with at least 20 or 30 of these without taking a breath. But I want to narrow these down to 5. These rules, and I think these are 5 of the bigger ones that we run across. And, of course, this all goes down to our most common answer to just about any question that starts off with, should I do this or that? What's that 2-word answer, Professor Plum?
It depends.
There you go. Oh, yes. All right, let's run these down. And some of these we've talked about fairly recently. Others we've talked about before, but I wanted to put them all kind of together here. So the first rule, quote unquote, that can and quite possibly should be broken is only withdraw 4% per year in retirement. The old 4%, we call it a guideline. Rick, what's the deal with that one?
Well, well, first off, it was based on flawed distribution strategy. Let's just throw that out there right now. They were using a systematic withdrawal from a balanced 50-50 portfolio. It's been around since the mid-90s, the 4% rule, and then a lot of people now, because we've been listening to it, because a lot of these rules aren't rules. They're guidelines at best, but we've heard them so much and so on. We're bombarded. We're inundated with the news about these being the rules that a lot of people just accepted at face value that, well, this is a rule. We can't break that rule. We got to keep going with this. If we want to make sure that our money lasts as long as we do, we cannot take more than 4% out. And now the original 4% rule was 4.5%, and it included an inflation adjustment every year. And unfortunately, in a static, statistical, academic environment, you have to do something, but people don't spend that way. They spend a little more when they're younger and a little less when they're older. So that's one reason why you can break the rule, but it was based on flawed science. But it has been bashed into our head so much that it's become a rule. It is a guideline, as you mentioned, at best. It can be used. It is very useful from a very high level looking at things, how we can guesstimate what we're going to do. But when it comes right down to running your portfolio, it comes down to who you are, what you're trying to accomplish. Maybe you're retiring 63, 64, and your Social Security is X, your spouse's Social Security is Y, but you've decided that you're not going to take one of your Social Securities for a little while because you expect one or the other of you to live, into your 90s, and you want to make that bet. And so you defer. But that means taking more from the portfolio. Otherwise, if all you did was take 4%, you'd have maybe the smaller of the two Social Securities, and it was reduced because you're under 65, plus 4% of your portfolio, and you're living on, so let's say that the smaller Social Security was $1,500, you had $1 million, you take $40,000 a year out, so you're living on $58,000 a year for the next 5 or 6 years, and then when you turn 70 or your spouse turns 70, they get $4,000 a month, $4,500 a month, and they get $54,000 a year. Your overall spending goes from 50-some thousand a year to 100,000 a year. But I wanted the money when I was younger, when I was able to enjoy it a little bit more, maybe when I was healthy. So that is one area. That's one of the main areas that you would break the rule, break the 4% rule, because you need to look at it as an overall picture. What is it going to do when all the money's turned on? I can spend my portfolio down a little bit more, knowing that I can take a lot less out of it in the future. So the 4% rule is a potential guideline. Now, if you're just looking at planning, you could say, well, spouse's Social Security is $1,500. My Social Security, if I were to start it right now, is $3,000. So that's $4,500 plus the 35 one is $42,000 a year, plus 4% for the portfolio at $40,000. So $82,000 a year is my target. That's where I'm at. That's 4% of the portfolio plus my current Social Security. But I'm going to defer my Social Security. So we'll take more out of the portfolio, still get the $82,000 plus inflation. And then later in time, when my Social Security kicks in, heck, the two Social Securities together are going to be like 70,000. I won't need to take much out of the Social Security, out of the portfolio going forward, and it'll be able to rebuild. And if I have bet correctly, and one of us lives to be into our late 80s and beyond, the legacy that we leave to our heirs will be a lot more, or there'll be a lot more money there to help care for us if we get sick.
Now, great point. Now, here's where a crazy idea can look rational. So, let's say somebody's heard of the 4% rule, and they ask somebody, and they say, "Well, how much are you taking out of your portfolio?" And they say, "Well, currently, I'm taking about 11% out of my portfolio." Now, that would seem nuts to anybody who doesn't have any additional information on that. In a vacuum, that seems nuts.
Okay, but the next question is, what's going to change in the future?
Yes, exactly.
Are you going to get a pension that comes in? Are you going to get a Social Security that comes in? Are you going to pay off your mortgage in 2 years and your distribution is going to go down to 2%? But so it's just a short-term thing. When you're looking short-term, but you're taking a long-term supposed rule and looking at it as a short-term issue, you're going to get probably the wrong answer.
Well, see, there you go. That's how breaking a rule in a crazy way can actually be the correct thing to do. Sort of going back to what I was saying about the lottery, although the lottery is a very extreme example. Okay, so 4%. That's one that can be broken. Let's do a few others here. Here's one we hear all the time. You should always reduce your exposure to stocks as you get older, especially without, let's say you haven't even considered your own situation, but you should always, because stocks are risky, and why would you own stocks when you're 88, blah, blah, blah.
90, 100 years old. Let's take 100 minus our age, and that's the percentage of our portfolio that we should have in stocks. That's another one of those rules which goes right along with what you're talking about. That is pure BS. Because that assumes that everybody of a certain age has the exact same portfolio, the exact same goals, the exact same needs. They're in the same, tax situation. Everything's the same. So everybody who's 65 has the same need from their portfolio as every other 65. And even if you have the same need, you have the exact same temperament towards risk, towards variability, towards volatility, not risk. That somebody... You could have two people that have very similar incomes, very similar portfolios, and one of them is very risk averse and just hates to see negative downturns in any part of their portfolio, and other people are like, well, that's not money I'm going to use for 20 years. Like, it can do whatever it does. Let it go. So it's all a matter of who that person is. So just saying that you shouldn't. And the other side of it is, I've asked this question in seminars over the years many times. In general, who can afford to have more money in stocks from a financial standpoint? A 65-year-old getting ready to retire, or a 95-year-old? And most people say, well, the 95-year-old should have less in stocks. Mm-hmm. No, the 65-year-old should have less in stocks. The 65-year-old has potentially a 30-plus year retirement distribution phase to factor in, where it's very unlikely that 95-year-old has a 30-plus year distribution phase to factor in. Is that a nice way to say it?
It is. But if they did live another 35 years, they could, be out on the speaking circuit somehow and be paid very, very well for what's your secret? No, I'm kidding. But you're right. You're right. And this gets down to something that we're not going to get into today. But this shows the difference between what I would like to call the science of financial planning, or the science of finance, let's say, and the art of finance. Now, the science deals mainly with numbers, okay?
Right. Math. Science. That is very hardcore. 1 + 1 does equal 2.
Well, yes, it does. You're right. So, and if you get, what's the rule? 7% per year you earn. You double.
Oh, the rule of 70. Rule of 72.
Yeah. What was that? I have it wrong.
Well, you're close. So you take 72 divided by the rate of return you expect to get, expressed as a whole number.
Yes.
And the resulting answer is the number of years it takes to double your money in a buy and hold situation. So if I get a 10% rate return, 72 divided by 10 is 7.2. So my portfolio, assuming no additions and no subtractions from the portfolio, should double in 7.2 years.
Yes. Now that is a rule that's true of every investor.
That's a rule. That's math.
That's every investor. That is true for every investor. Also, if your portfolio loses 25%, it takes 33% gain just to get back to even. This
Those are math. Yeah. And so the hardest part of that first one is get 10% every year.
We should say that.
Without variability.
Yeah, it doesn't happen very often. Yeah. Okay, but those are that is true across. That's for every investor. But the things like the 100 minus your age. When you're 90, you should own 10%. I mean, that's ridiculous.
That's not math.
It's not. And this
it's math, but it's not based on anything in science. It's based on feelings.
And this is where the art comes in. And the art of this is where I think a financial advisor can provide the most value, because everyone's situation is different. And why would you break this so-called rule? It's not even a rule. It's just kind of a theory about reducing your exposure to stocks as you get older. I mean, there probably are some people who should reduce their exposure. I'm sure there are circumstances out there, but it's certainly not true of everybody. So
when you're 95, there's some tax reasons to not sell those stocks.
That's true. Hey, listen, Grandpa. I know you're leaving this to me, and I sure would like it.
It's a reasonable stock. I mean, okay, you're a little overweight in it, but it's a nice stock. It's not one that's we're really worried about. And you've got like 95% gain in it. Why don't you give it to me when you're through using it, meaning after you pass?
Yeah, I'll take it when you're gone. I'll check back with you in 6 months. This is awful.
Oh, ow.
I shouldn't say that. But, I mean, this is true. It would be better to inherit something like that for the step-up in basis. All right, so that's another one. Always reduce your exposure to stocks as you get older. That rule gets broken all the time and probably should. Okay, a few others here, just in the interest of time. Here's one that we discussed not that long ago, but it was always wait until 70 to take your Social Security. Now, I hear that one more than I hear always take it early. But the idea,
you hear that too, though.
Well, you do hear that. So the idea that there's an ideal age that everybody should wait, maybe till 70 or whatever, to take your Social Security. Let's take a couple moments and debunk that.
Well, not everybody has the same life expectancy. Not everybody has the same needs in life. Not everybody has the same temperament. And we're talking about whether a single person should wait or not wait, and a married couple, where there's potentially two Social Securities. Sometimes, like I was talking to somebody the other day, who, if they start their spouse, it was a traditional family. Their spouse has a very low Social Security benefit. And their spouse is actually a little bit older than them. But if they start their benefit today, they're 66, call it, close to full retirement age, their spouse will get a pretty good sized benefit. Basically half of what they're going to be receiving. And if they wait 4 more years, then their benefit will be larger, but the spousal benefit won't change. It's because that spouse is already full retirement age. So they just give up that spousal benefit for the next 4 years. Well, that extra money coming in extends the break-even age to waiting. Now, in a single life, single person, no other benefit situation, taking it early, you take it reduced benefit. And then if we look at dollars from a portfolio supplementing, however you want to look at dollars in, dollars out, waiting gets you a much bigger benefit, but it takes a long time for that extra money to pay yourself back for the money you missed out on those first 8 years. And it usually, given different parameters of variability, of what returns and cost of living adjustments and things happen, takes maybe early 83, 84, or 5 years of age for it to make sense to make waiting until 70 pay off. But if you live that long, it'll pay off. But when we introduce another benefit into the situation that isn't changing, isn't getting any bigger or down the line, that extends that break even to 90, 91, 92. Do you really want to bet, and that's what you're doing, that you're going to live that long? So it is very dependent upon the situation. Even in cases where it's a situation where they can afford to wait, and so you basically set the portfolio up to take more money early and then take the higher Social Security at age 70 and then let the portfolio rebuild over the next 15 years or so. Some people just don't like that idea, and they feel better. They feel less anxious about their portfolio. They feel safer by taking the Social Security when they're not working at 66, 65, whatever it is. Mm-hmm. And in that case, the science of the break-even age gets thrown out the window, And the art of the emotions comes into play and says, I'm going to take it now because I like it. This just makes me feel all warm and fuzzy.
Well, and that's really, I think that's the essence of the whole idea of planning, because, I mean, money means different things to different people. And I think that's the more important part of it. We've said so many times where, hey, you know what, it doesn't make sense from a numbers standpoint, but this is what you want to do and it makes you feel better. Let's just do it, you know?
Yeah, sure, when you're 90, your kids may have gotten a little bit more money as a legacy if you'd waited, but what's it matter? Is that a deciding factor for you?
No. Take a look at your life. How are you living? Are you enjoying it? And that's the whole point of it. So, all right. So that's another one to break. We've done 3 so far. Only withdraw 4% per year in retirement. We know we can break that rule. Always reduce your exposure to stocks as you get older. Easy rule to break, and most of the time it is. Always wait until 70 to take Social Security, or always take it as early as you can, whichever. We've broken that many times, and that's certainly breakable. 2 more here. The next one is, I used to get this from my grandmother. Never touch your principal. Just live off the interest and dividends. Now,
the world's changed a little bit since Grandma was doing that.
Well, it
used to be live off the interest and dividends, but we had different types of stocks in the time. Back in the, when I first started in this, in the 80s, and reading about it and learning about it before that, utility stocks were stable and paid a very high cash flow. Utility stocks today are not the same animal that they were 45, 50 years ago. They are very volatile at times, and they're dividends. But living on the interest alone, right now, to have a guaranteed interest portfolio and try to get to that 4% rule, if you wanted to play that, first off, that's about what you're going to get. You're going to get about a 4% rate of return. So you've got $1 million. You're going to have, call it right around $40,000 a year, fully taxable, at least, for the most part, federally taxable. Maybe your state doesn't tax you. But you're going to have $40,000 a year. And guess what you're going to have 20 years from now? $40,000 a year, because there's no inflation hedge, there's no growth built into it, anything of that nature. So just live, and that's assuming you can get a 4% over the wall. I think you can ladder it out that way right now, so it'd be close. But I remember, there was a lot of preferred stocks that people would use in the old days, where I think it was Ford, but don't hold me to this. There was an 8% Ford stock out there that was just gold. It paid 8% for for the 100 years that it had been. I don't afford it at that time. It had been in 100 years, but for as long as it had been out there, it had been paying 8%, and it paid 8%. So if you had $100,000, you got $8,000 in interest or dividend off of that stock, and it did that exactly right up until one day they changed the dividend, because preferred stocks aren't guaranteed, and they cut it in half. Yeah. And not only did your income get cut in half, but guess what happened to the value of that $100,000 stock, or the value of that stock? It didn't have to be $100,000. It got cut in half too, because people bought it for the income. And if I'm getting half as much income, it's worth half as much to me. So not only did your income go down, but you got creamed on your valuation. So the rules of only touch interest, if we want to have some potential to keep pace with inflation, to potential to let it grow a little bit, we have to think outside that old box and say, well, let's find a way, again, to use volatility to our advantage and live off of areas that don't have volatility, because I don't want to turn that volatility into risk. Going back to last week's podcast, if you didn't hear it, you should. It's each one of the podcasts build on the last one, so you got to know what was class.
It's a story arc, is what it is. Yeah,
last class we're building on what we learned last week.
Yeah, exactly.
So it's just a matter of find a way to make it work and get better than a 4% overall rate of return. Yeah, you can do it. You just can't do it the way that the generalists say to do it. It doesn't work in a systematic withdrawal balanced portfolio that averages 6 or 7%. It doesn't work in a stock portfolio that averages 10%. It can work sometimes, but it doesn't work all of the time.
Yeah, there's no guarantee.
What we don't, and I sure don't want to be on the losing end of that.
No, and it's one of the reasons that I think buckets was developed, certainly thought of at the time, because with a pure bucket strategy, you are spending principal. In fact, some cases you're spending principal all the way down.
Well, let me change that a little bit. You're spending principal on a portion of your portfolio. You are reinvesting gains and dividends and other things on the rest of the portfolio. So while you may, in a buckets plan, you may be spending principal on a third of your portfolio, all earnings are reinvested on the other 2/3 of your portfolio. The other part of the portfolio has some variability. The other part is where the volatility is. Reinvesting helps all of that, and it gives you time to get those better than in my example of 4%, potentially better than 4% rates of return. And lately, we've seen significantly better rates of return, but they come at a cost of some negative volatility from time to time. We saw that earlier this year. Would have been a bad time to be selling off stocks to live on. 2022, bad time to be selling stocks or bonds to live off of. So there. And when is the next downturn going to happen? Heck, by the time this podcast comes out, we may be in one. I don't know.
That's right. Remember, we do record these at least
a couple days.
At a time. Yeah, exactly. So the idea, never touch your principal, just live off. There are a lot of reasons to break that rule. Just keep that in mind. It's one that's been around for 100 years, and the old grandmother rule. That's why I brought it.
Now, if your distribution is low enough, then and you are conservative, then that works fine. Mm-hmm. If your distribution is, if I need $40,000 a year, but I don't have that $1 million portfolio, I've got a $5 million portfolio. Okay, I can live off interest alone and still have money left over to reinvest and let it grow a little bit, and I don't have to look for negative numbers because I can afford to do it. If your distribution is low enough, in that case it was 1.25%, life is pretty easy.
Well, and that's why I want to make it clear that while we're giving you these rules that you can break, it doesn't mean that you always should break them. There are times when each one of these rules can be followed and without any problem at all. So we're running out of time, but I wanted to just, along these lines with buckets and all that, we talked, and I think it was last week, on this whole idea of modern portfolio theory, and we're not going to get into that so much, but the idea of that, and this is the last rule that we're going to talk about, was that you should rebalance regularly no matter what. And this kind of goes along with that old idea that you take a systematic withdrawal, rebalance, systematic withdrawal, rebalance, always be 60-40 or always be 70-30. Very quickly, Professor Plum, what are your thoughts on that?
Well, my initial thoughts from what you were talking about is this is where science and art just collide. Mm-hmm. And the rebalancing every month, every quarter, whatever some systematic basis regularly is a mathematical issue. But it also, I think you need to have a little bit more art to this because things drop and we really should be potentially letting them run a little bit. Things go up. And instead of just selling off every month when things are up, I want to wait to see it be up a lot more than I expected. So, if we're looking at a 60-40 balanced portfolio, 40% is in bonds and 60% is in stocks. We expect 10% in stocks. We expect about 4% in bonds right now. That's just so by the very nature, if stocks went up at 8%, but bonds only went up by 4%, my portfolio will be a little bit heavier in stocks than it wouldn't be in bonds. Even though I potentially underperformed my expectation on the stocks, it would have me rebalance back to 60-40. Mm-hmm. That is not a good time to do it. So that's I don't like that rule for the rebalancing, and I don't like the 60-40 balance mix for that particular issue either. But so it just there's a lot of things that don't work really well. It's kind of like the idea of target date funds. Mm-hmm. They sound so nice on the surface. It's a great do-it-yourself. Somebody else doing it. I don't have to think about it. It's the professionals are doing it. It makes it seem nice because I want it to be easy. I want it to be done for me. I want to be the recipient of good stuff without having to work at it or pay for it. And so that's why a lot of this stuff is designed around don't use an expert. Do it yourself. Do everything yourself. And here's how you do it. But they don't, and if you don't know how things work, then you don't know that this doesn't work very well. There are better ways to do it. but they're harder to do. They take a little more understanding. They take a little more knowledge about what's happening. But I don't want that. I want to do it myself. Free-based system. I want to get a good rate of return. I want to have no volatility. I want it to be tax-free.
That's right. I want no downside at all.
But I want really good upside.
Yeah. I got to have it all is what I want.
And I want tax-free. You got to throw that in for good measure.
That's right. It's not going to happen. It's not going to happen. These are, as we said, rules that you can break. You shouldn't always. There are times
rules to not live by.
Yeah, rules to not live by. Well, again, this all goes back to more of the art of financial planning, which I think if you have an advisor who understands how this works, I've likened this to a doctor, where a doctor knows all the medical stuff, but is not understanding necessarily what the patient's emotional needs are or what their life needs are, or, any of this stuff. And I think the better doctor is the one who does understand that. And I believe that the better financial advisor is the one who understands just exactly what it was you were saying, Rick.
And even good doctors will refer out to other specialists at times. They don't try to do everything in-house. They have people that are outside of their area of expertise help them, whether it, be a different disease, whether it's, physical structure, I don't know. You got all kinds of specialists. But the same thing with the financial planner. No one financial planner is 100% proficient in every aspect of everything. Portfolio, composition, risk management, looking at all that gets carried away. That's where CFAs are wonderful.
That's chartered financial analysts, by the way.
That's an analyst, and that's what the stock pickers are mostly. Then you got, your tax people, and understanding tax returns. Now, there are some of us that are pretty good at that, but I'm always going to talk to tax people about this stuff too, because they may know just in certain areas just a little more than me that makes it better for that client.
Like a CPA of some kind, a certified public accountant. Yes.
Or an EA, enrolled agent.
Yes, yeah. And they're good with the numbers. Those are the science people. And then you have the people who are dealing with the art. So if you want to know more about this stuff, I should just mention again, Professor Rick Plum and all the advisors at Lucia Capital Group enjoy doing this. This is all, it's art and science, but the art is the important part of it. Give them a call at Lucia Capital Group, 800-644-1150, 800-644-1150. You know that number by now. But if you haven't talked to Professor Plum or any of the Lucia Capital Group advisors before about your portfolio, is it doing what you think it should be doing? Does it match your goals? Are your assets matching your liabilities? Find out. If not, they probably should be. 800-644-1150. Go online, luciacap.com, LUCIACAP.com. Find all kinds of downloadable brochures. We have guides, all this stuff. Just type in the search bar, whatever you like, and chances are we've got something for you.
We have guides, not rules.
No, guides. That's right. Hey, see, it all comes back to that, doesn't it? I'll tell you. Not bad, Professor, not bad. Don't forget, subscribe. Professor, you mentioned this at the top. You cannot miss, you can't miss an episode because you'll say, what the heck are they talking about? Make sure you don't. Subscribe to this podcast. Go to Apple Podcasts and Spotify and download every episode to your device. Listen wherever you can and let us know if you have any questions about this. Maybe we can talk about it. It'll take a couple weeks because, we do this a few weeks ahead of time, but we'd love to hear what your thoughts are. Out of time. My thanks to Professor Rick Plum, certified financial planner, professional and accredited wealth management advisor. Thank you so much.
Thank you. You're welcome.
For Professor Rick Plum and the rest of the folks at Lucia Capital Group, I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. Thank you so much for listening. Talk to you all next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. This material should not be considered considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Stock investing includes risks, including fluctuating prices and loss of principal. Preferred stocks are sensitive to interest rates. The share price generally falls as prevailing interest rates increase. Other risks include perpetual life or very long maturity, a call feature, low credit standing, deferrable dividends, and, for traditional preferred stocks, depressed yield due to demand from corporations that receive favorable tax treatment. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Before investing, carefully consider a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.